So, good morning. Here we have quite an interesting story to tell, I guess. And we're going to take a slightly longer term. I'll do one very soon after, just focused on crypto. This is the Fed's breakdown, why we might see, and I probably think Q2 is going to give us a really good platform for us to have a massive pump in crypto and the traditional markets. So, will we probably see a Christmas rally? I think we will. And then another question is if we have a Christmas rally, how long can it last for? Will we see a pullback, or are we just Santa Clausing all the way to the end of next year? Let's find out. Let's have a look at this over here, I should say. As you can see, this is the jobs report from Friday. So as we know, the jobs report comes out at the end of every week, the first week of the month. The first week in the month is what I should say. And so we had a terrible jobs report, but the markets didn't really act too badly. It was actually relatively good. You know, S&P's up, crypto is down, I will say slightly down by, I think 1.5% today. But looking at this, non-farm payrolls. So they came in above the forecast, but when they were revised, they actually, kind of hit the sweet spot. So it's not so bad. This is just the number of jobs that have been added. And bear in mind, this is from the previous month. Okay, it's from the previous month. So although this shows us bad data, okay, because it's 261, whereas it was forecast for 200. We're actually looking at this, it was revised up to 315 and it came in under that. So maybe it shows that there is some kind of slowdown in the jobs market. Unfortunately, though, looking at the unemployment rate, it's gone up, which is obviously very bad for the common person in the US, but very, very good for the Fed. And this, I believe, is one of the key catalysts as to why we're seeing that little pump in the markets. And I'll just go through, as we know, we have CPI coming in later on in the week on the 10th. That's going to happen middle of the week. I believe actually it might be Thursday. And then we have the Michigan Consumer Report. Lots of information going out from the UK and also inflation for Germany as well. Also, yeah, not really too much that we can expect here. I mean, these numbers are probably made up anyway. They stopped putting them out for a long time. And then they're just like, oh, yeah, actually, no, now we can, because we control everything and the media, we can just say what numbers we want. Anyway, we had our 75 basis point hike, as we know, last week. We're now moving into a question of are we having a 50 or a 75 basis point in December? Fed's bargain sees potential for a higher end point for rate hikes. So what he said was that, originally we planned to have rate hikes sit at around about 4.6, I think it was. 4.6 was the end goal initially, like back in July. But obviously that's all changed now. So he spoke shortly after the US Labor Department reported stronger than expected job growth, again, which we just saw, for October. Something he said was consistent with what I hear from contacts, which is that demand remains solid. And that's not good. So obviously, this is prompting him to say, look, we need to be raising heights for a longer period of time. Coming 2 days after the US central bank delivered its fourth straight 75 basis point rate increase, Barkin remarks to CNBC signaled that the pace of tightening may slow from here. So this is what a lot of people are saying. We are going to slow down the amount, not the amount, sorry, we're going to slow down the rate of these hikes. So we've had 475 basis points. We're now sitting at 4% in the US. And so a 50 basis point does look most likely. But another article is saying Fed watchers put finger in the air and see rate hikes above 5%. This is pretty much guaranteed. We will see this, not by the end of this year, guys, because we only have one left, but we're looking more into the likes of like May, for example. You see, this is where we start to think, okay, well, we're going to go above 5%, but by May, we could be even as close as past 5%, sorry, and up to 5.5, which would be pretty crazy. And another key thing is, guys, we're slowing these down, but we're still going to stop the increases. We're not going to start taking money off. We're not going to start removing those rate hikes really for quite a long time. So we will see an awful lot of pain. So in September, they estimated reaching a target of 4.5 to 4.75. So at some point, if we do get up to I don't know, maybe a 5.75 or even a 5.5, we will have to start coming off at the end of next year. So this is something to kind of watch out for. Where have I just gone? Just, oh yeah, here. And again, look, you can just see hawkish Fed sparks yield rise as peak policy seen rates seen higher. So obviously, if there's going to be, let's say, interest rates of 5%, then obviously the yields are going to grow as well. Because less people are like, oh, I don't want to be buying bonds at this yield. So then the people stop buying, the bond yield goes up, and everyone is very happy. Just speaking of bond yields, over the past year, you can see how many points we're up on the like of the US Treasuries. So over the past year, on the 3-month, up by 407, which is a crazy amount. The 12-month, up by 459. So it's crazy. We're now sitting at a yield at 4.71, which is absolutely insane. Now, just to tie this slightly into crypto here, I'm looking at the NASDAQ and how the biggest tech companies are boosting stock quants on Wall Street. And this is because they're underperforming. They're essentially underperforming. So if you do look at tech stocks, and I believe we have yes. So bigger is not always better. These are the mega caps are falling more than the market this year. Not good. And this is causing a lot of quants, basically quantitative hedge funds and quantitative investors, to actually go for different companies, so having a look at this sentence here: with interest rates spurring an abrupt end to the leadership of big tech, the largest technology companies are wielding less and less power over broader indices. As former high flyers, Meta and Amazon crash anew in the latest wave of selling. And everyone's getting out of tech. This is making tech look a lot less interesting. It's making this whole risk-on asset look less interesting. And I think that's why there is such a sluggish demand for the likes of crypto at the moment. And then there are some other elements, and I'll go into those, like I said, in my next video. But we are really looking at companies just looking for value somewhere else. They're going to, as opposed to Amazon, for example, looking at things that are recession proof. If you have spare cash, you go and buy stuff on Amazon. Everyone loves to receive a package. Don't take that in a dirty way, but everyone loves to receive something from Amazon. We all love shopping, right? If we have no money, we don't go shopping. But there are some things you have to buy. You always have to buy food. You always have to buy baby food, for example. So then people start looking into things like Johnson & Johnson, and these are considered potentially recession proof. Also moving into energy as well, because you might turn your lights off more than usual, but you're still warm in your home and you're still having your lights on at some point. So we are seeing this like fall off from the big guys. And back onto inflation here. So US consumer prices have seen rising by 7.9% in October from 1 year ago. It's still extremely crazy. We are still seeing this continuation. I do think that we are going to have, and this is why I like the idea of Q1, Q2, probably Q2, because we're going to get a bit of a culmination of different points here. So just looking at this here, we can see that we have what is it? Okay, so this is the CPI, so the consumer price index. Also, good morning to everybody. I was a little bit sick over the past couple of days, so I apologize. But anyway, so we do see that CPI is still increasing. It's the one in black, right? And then we have the core inflation, which is the one in pink. And so the core inflation is still increasing, even though CPI is coming down, because CPI includes food and energy. Now, with the crisis in Russia, obviously there was a massive grain crisis. There's an energy crisis. So these things, as they begin to get sorted out, they will start to come down. So CPI will come down. Core inflation will begin to kind of meet. Another thing that I think, I guess will be priced in, there's a massive housing market bubble in the US, okay? And I do think we're not going to have a massive crash like 2008, but we will have a massive correction, okay? So I do think as housing prices fall in the US, rents will fall. And then, because even though rates are high, essentially just the market will continue to move down because there'll be less people interested, right? So as housing, which makes up 33% of hello, that's my dog, of the index, we are going to see prices move to the downside. And so that will then kind of have an effect on core inflation and also CPI as well. Okay, thank you, mate. Appreciate that. So this is one thing that I do think, we should probably be quite aware of. But then also, where we're hearing at the moment, Google announcing that they're going to stop hiring as many people. Loads of these job reports coming out are still quite strong, but we haven't seen the effect of the newly announced through the earnings season, these newly announced cuts. And so when these cuts come into place, there's going to be essentially higher unemployment, which is a very good thing for the Fed. We also then going to have higher profits because there's less costs. And I think because of this, the Fed are going to be much more like open to being friendly aids. Oh, they're going to be much more likely and much more open to lowering rates faster. But we are going to have to wait for this lag time to actually have an effect in the markets itself. So anyway, just finishing up here, guys. Stock market could be poised for a Santa Claus rally as midterm elections tend to juice returns, which is absolutely true. They do. So since 1942, the S&P 500 has delivered an average 3, 6, and 12-month gains post midterms of. So it seems as though most of them come in the 6 months, not immediately after, but then over the next 6 months. Which again, if you add 3 months from the election, which I don't know the exact date of it actually, but anyway, it hasn't quite happened yet. And so, let's say it happens middle of this month. We then have 3 months, which brings us into February, and then 6 months brings us into Q2. So this is something that we can begin to think, hey, this might actually form quite well here. Supply chains getting fixed from Corona, China opening up, and then post-election rally, post-midterm rally anyway, plus also inflation starting to come down, and also the fact that the Fed might then be like, look, yeah, we've gone quite tight, but inflation is now down, and so combine that with companies not hiring as much, then we could be in for a pretty good rally. So this is just one thing, a couple of things I wanted to mention here, and this again just goes into what we might be looking at for a stock market rally. But anyway, that is pretty much everything, guys. Those are the reasons why I feel quite good about Q2. That should be happening, I would say. We're 5 months away from Q2 now. So yeah, that's my 2 cents. Look out for some updates, which obviously we'll be providing, and I'll do a video now just on crypto to tell you how it's all going. Thank you very much for watching, and I will see you soon.